Approach you read today to those in debt. Struggling consumers have been hit with debt judgments worth $3 million in the past week, with credit unions taking more of the actions than banks and other creditors, strangely. They're opting to take members to court to force the repayment of an outstanding loan, with the average value being about €7,000. The arrears of the state's 407 credit unions have now risen to $1 billion. And the latest figures from Stubbs Gazette show the credit unions continue to top the list of those securing registered judgments. The cooperative lenders were traditionally reluctant to take legal action against borrowers, but lately they've turned to the courts to get their money back if they feel they've no other option. If someone fails to pay a debt, the creditor can go to court and get a court judgment confirming that the money is owed. But how many consumers would this affect? How difficult are people finding it to pay back credit unions? I guess it must be the same as paying back anybody these days. And was there ever or always an attitude that the credit unions were perhaps a little softer and more gentle when it came to debtors? And what sort of debt are we talking about compared to bank debts? To talk about this, the markets correspondent with the Sunday Business Post is here, John Ihle. Hello, John.
Hi, Scott.
And James Treacy, the Managing Director of Business Pro Stubbs Gazette, is here as well. Good evening, James.
Good afternoon, Scott.
We were in touch with the League of Irish Credit Unions and a number of credit unions, and none of them was in a position to give us a spokesperson this evening. John, when you see credit unions behaving in this fashion, more and taking more actions recently than banks and other creditors, how would you interpret what's going on there?
I'd have to say it's not a huge surprise. We've been, I guess, expecting more aggressive action from financial institutions of all kinds for quite some time now. And it's been well known that the credit unions have had an arrears problem for at least, let's say, 2 years, when the regulator really started to take an interest in the financial stability of these community lenders. But their major problem is that all of their loans are unsecured. They're really only held against the deposits you have in the credit union, and they're essentially given on good faith. You know, a lot of loans are, but they're not backed by a piece of property, or they're not backed by a car or anything like that. So when it comes down to it, if a loan is really long gone, the credit union doesn't have a whole lot of choice for getting it back, unless they're willing to just defer or, have endless forbearance, which at some point becomes unsustainable.
Right, so that makes sense. So it's unsecured borrowing. James Treacy, I mean, the figures I quoted were from yourselves. More and more credit unions, is it localised in the country? Is it more Dublin, or is it everywhere?
It's right across the board, Scott. And I agree with John. The vast majority of credit union debt would be unsecured. So I was looking at some of the figures for last year. It was quite extraordinary. There were a couple of judgments taken against credit union members for over 800,000 unsecured debt, which is quite extraordinary. But the good news is, when I was analysing the figures for credit unions, although the amount of bad debts being pursued through the courts has increased by about 50% from 2010 to 2011, when you actually analyse the figures, at least 40% of the people, the members who've been brought to court for non-payment of debt, are actually paying down the debt, which is quite extraordinary, because if you compare that to the likes of AIB, people that they brought to court, or companies they brought to court, which would be mostly secured debt, only 13% of those debtors are actually making an effort to pay. The figure is 18% for Bank of Ireland, and for Anglo-Irish, it's 0%. I suppose there's no surprise there.
There's no surprise there. So what could we take out of that, John? Is that perhaps people are making less of an effort, or they feel that the credit union is more compliant or more emollient or more understanding than a bank?
I think more understanding is probably the accurate way of putting it. I mean, let's not forget, when you put your money into the credit union, you're effectively saying, I'm making this money available not just for a return for myself, but for the borrowing needs of my community and anyone else who is a member of that credit union. And in good times, obviously that works very well. In bad times it becomes tricky, like when you're not paying your credit union back. In effect, you're stiffing your neighbours, and that's where it gets hard. And you asked a question about, is it all credit unions or just some of them? Geographically, it's spread quite wide, but some credit unions are stronger than others. And one of the big problems with these community lenders is that you'll see a concentration of certain types of lending or certain types of problems in a small area. And we saw this recently when Newbridge Credit Union was taken into administration earlier in the year by the central bank.
Was that the clarion call to other credit unions, perhaps, John?
Well, it was maybe a special case. They had a few very large exposures. They made some ill-advised loans to some local property developers. But think about what that does for a second. I mean, my information was that it was around 3 million euros, and this was quite a significant chunk of their overall book. And if that puts the pressure on the credit union so that they can't lend to other people within the credit union, or that they can't afford to use forbearance to help people who are having trouble pay because they have a couple of big exposures, it can actually cause a big problem in a small locality because they're geographically concentrated.
Can I just ask a question of you, James Treacy? With this situation, is there any case at all to be made for NAMA for credit unions?
Well,
we did it for banks.
Yeah, well, I guess there is, but as I say, 43% of all the members who have been brought to court are actually making a very significant effort to pay down on that debt. And I agree with John. The credit unions are actually they're all set up as limited companies. So there's over 400 in the country, and a lot of them, the vast majority, are very professionally run. But there are a small minority which wouldn't be. So that you would have maybe managers and some of the credit unions who wouldn't have expertise when it comes to granting loans, property loans especially, and in some cases that's where they're seeing significant write-offs.
John, I just one of our listeners on here, and she says to me, I have a credit union loan of about 4k, shares of less than 2k. I'm supposed to pay 160 a month, but I haven't paid it since November. It just seems the easiest bill to skip. They don't contact me, and there's no hassle with skipping a payment or two here and there. This morning I got a letter from them advising me that I've missed a payment on 10 consecutive weeks. I rang them and told them I'd make a payment next week. They noted that in the computer, and that's it. End of problem. It seems once you contact them and make some effort, they turn a cheek, so to speak. And she feels that they should get harder on people like her.
Well, I mean, they probably will at some point get harder on someone like her. I mean, the thing you have to remember is, okay, you may be freeing up some cash flow for yourself when you skip a few payments, but if that credit union, and most of them do this, report into the credit reporting agency, the name of which I can't remember, the
ICB, yeah.
The ICB. I mean, that's a black mark on your credit record. So the next time you try to raise finance, it's going to be harder for you.
Right.
I mean, it's never a good idea to just ignore it. I think that's the standard advice.
Well, she's saying there she's pretending to not ignore it, but still she's no intention of paying it, but she calls up and says, look, I'm doing my best. And really, James, isn't that the whole point there? What John was saying is that the credit unions, probably of necessity and probably by reality and circumstance and considering the service they provide, don't have the debtor pursuance services that, say, a bank would have.
Well, I guess, yeah, because they are community lenders, and typically your manager and the board would live in the locality, and they would know possibly most of the members by name. They would know them to see on the street. So there is the perception out there that some credit union credit officials might be a bit more lenient. But again, as John mentioned earlier on, it's most of the members are performing, and credit unions pay their members a dividend if they're in surplus at the end of the year. So if there are a certain element that are not consciously paying back their loans, it is affecting your next door neighbour. So you're not going to get a dividend at the end of the year. So that realisation is kind of sinking in with most credit union members, and they're kind of urging the management to get tougher on people who, not necessarily people who can't pay, but people who won't pay.
Who won't pay. So we need to get the message out. If you don't pay the bank, you're screwing the bank. But if you don't pay the credit union, you're screwing the community.
Exactly.
Okay, we'll leave it there. James Treacy from Business Pro and Stubbs Gazette. Thank you very much, James. And always good to talk to John Ihle. Thank you very much, John. John is the markets correspondent at the Sun.